Mike Tyson, yes, Mike Tyson once said, "Everybody has a plan until they get punched in the mouth." Everyone talks about process and how their process is better than the other person's. But when it comes right down to it in the final investment selection, it's typically a group of mutual funds. And those mutual funds are either managed by the firm or by someone else. In other words, your money's outsourced. There is a difference. Do they mention exit strategies or defensive measures in your account when the market volatility increases? If you don't hear the terms defensive measures and exit strategies, you're not getting any. I don't recall a coach in high school or college ever not having a game plan or a practice schedule every day we stepped onto the floor. And our job was to execute that during practice or during the game. So in most game situations, at halftime, you evaluate how the first half went, and you may change or adjust your game plan for the second half. Likewise, the other team typically made adjustments at halftime, so we had to adjust to their adjustments. The overall point is we had to adjust our game plan during the entire game. In all honesty, if we focused on our strength, then we normally didn't have to worry about the other team. If we executed our game plan properly, then the outcome was pretty successful, and it really didn't matter what the other team did. Your investment strategy needs to work the same. Think of it this way. In sports, you don't play offense 100% of the time. You transition between offense and defense and back again at various times. Shouldn't your investment process be just as flexible? We utilize relative strength investing. Others in the business refer to this as momentum. Simply put, we want to own the strongest areas of the market and avoid the weaker areas. Instead of a shotgun approach, meaning we own a little bit of everything, equities, bonds, commodities, international, fixed income, we only want to own the areas of strength. If we don't invest in the weaker areas and allocate that money or overweight that money to the stronger areas, it would stand to reason that our returns should be better. For example, I played ball in college, so let's use a baseball analogy. You're the owner of the baseball team, and my job is to put a competitive team on the field. If we keep the same players year in and year out, they will get older, slower, and probably don't compete quite as well. But if we draft, if we trade, if we upgrade our lineup from time to time, we will be pretty competitive. Your money should be invested the same way. Also, as the owner of the baseball team, do you allocate your money to the role players or the better players with the more positive attributes? We will allocate money to the stronger players in the strongest areas of the market. We do have other, again, allocations, but we don't overweight in those areas until they prove to be in a leadership position. How do you want your advisor or money manager or general manager, if you will, allocating the money in your portfolio? Better investments with more positive attributes will give you a higher level of success. Shouldn't your money be invested the same way? We also focus on sector rotation. Areas of the market rotate in and out of favor. So, as the leadership changes, we make adjustments, tweak your account, or weed the garden, if you will, of areas of underperformance. Own the leadership, sell the laggers. This allows us to always own the best of class. It goes back again to the question. If you were to take some of the underperforming areas or weaker parts of your portfolio out and reallocate that money to the stronger areas, don't you believe that your performance would be better? We also utilize fundamental and technical analysis. Fundamentals tell us what we want to own. Technicals provide us a way to evaluate at what price or when we want to own them. So by utilizing the two together, we feel like we can make a better decision for our clients. There's times that we focus on wealth accumulation, making money while the trends are favorable. In other words, we have the wind at our back. And there's times we need to focus on wealth preservation, raising some cash, getting rid of some underperforming positions. In other words, being a little bit defensive when necessary. It may be like swimming upstream against the current. We're able to grind out some return, but over periods of time it can be a little difficult. Keep in mind, regardless of the volatility of the stock market, there is a bull market somewhere. You just have to be willing to look for it. Favored sectors. That simply means that money's flowing into this particular area of the market. More stocks in that sector are on buy signals than sell signals. And when more than 50% of that sector of the market is on a buy signal, then it becomes a favored sector. When stocks are being bought, it pushes prices up. Therefore, you're in a favored sector of the market. Also, demand is in control. Consider the reverse. If it's an unfavored area of the market, money's flowing out or positions are being sold. When stocks are falling, that means supply is in control. And folks, supply-demand relationships are real simple. Whether you're talking about a stock, a gallon of milk, or a gallon of gas, price is the true determination of what a stock is worth. Keeping a manageable number of positions. One of the most popular and widely accepted and utilized investment strategies today are mutual funds. Does your current advisor have a manageable process for managing multiple positions in your portfolio? Stay with me on this. Most mutual fund portfolios have, say, 10 individual mutual funds. And each one of those mutual funds has 100 to 150 stocks. So in all total, there's over 1,500 stock positions within that model. There's no way anyone's going to be monitoring 1,500 stocks on a daily basis. We also utilize exit strategies. At Strong Tower Wealth Management, this is one of the cornerstones of our process. Exit strategies allow us to raise cash, be defensive, put the money on the sidelines if need be until the dust settles, then have an interest strategy to deploy the money at appropriate times or at least at undervalued opportunities in the market. Here are just a few reasons to raise cash. Sectors rotate out of favor, to take profits off the table, and increase cash in response to market volatility. We believe the utilization of cash as an asset class is vital to lowering the risk in our clients' accounts. Studies have proven that if you cut your losses quicker, that would dramatically increase the performance of your account. The most important aspect of the whole process is execution. Being able to execute a strict buy and sell discipline when necessary. You can have a great game plan, a great strategy, a great process, but if you can't execute that game plan, it's not worth very much.